Hey everyone, it is me. I used to think investing was some kind of secret code, something only finance gurus understood. I was 20 something, full of energy, and eager to make a lot of money fast. I saw all these headlines, heard whispers about hot stocks and crypto that was guaranteed to go to the moon, and guess what? I fell for it. Every single time, my journey into investing honestly was a disaster. I was chasing every shiny new thing, throwing money into whatever everyone else was talking about. Short-term speculation, meme stocks, trying to day trade. You name it, I probably lost money on it. I buy something because the price was shooting up, then panic sell when it dipped. Losing money on both ends, it felt like I was constantly gambling with my hard-earned cash, watching my savings shrink instead of grow. I bought into so many scams, convinced myself I had found the next big thing, only to realize I was just another mark. It was painful. Watching all those hours I spent working just vanish into thin air. I had no idea what risk management even meant. I just went all in, hoping for the best, and usually getting the worst. It was a really tough lesson to learn, and it cost me a good chunk of my savings. But after taking some serious hits, I finally woke up. I realized that the get-rich-quick mentality was actually a get-poor-quick scheme for me. I had to unlearn everything I thought I knew about making money, so I stopped chasing the hype. I stopped listening to random internet gurus. I started actually learning about proper financial principles, focusing on steady growth and low-risk strategies, and it changed everything. I realized that building wealth doesn't have to be complicated, stressful, or involve endless hours of research. In fact, for most of us, especially in our 20s, it is actually incredibly simple. You don't need 40 or 50 different stocks. You don't need to be a financial wizard. You just need one thing, one simple investment to invest very well, and that is the SP 500, specifically an ETF like VUT. That is what I personally invest in, and it is what I wish I knew about when I first started. In this video, I am going to explain why I believe the SP 500 is truly the only investment you need for long-term success if you are serious about building real wealth without all the stress and heartache I went through. Before we dive in, let me ask you this. Do you think it is smarter to own an ETF that holds 500 companies, or would you rather try to pick individual stocks, hoping you pick the right ones? Seriously, drop your thoughts in the comments below. I'd love to hear what you think. So what exactly is VU, or the SP 500? VU is just Vanguard S Exchange, traded fund that tracks the SP 500 index. The SP 500 itself is a stock market index that represents the 500 largest publicly traded companies in the US. These are household names, the giants of industry like Microsoft, Apple, Amazon, and JP Morgan. When you buy VU, you are not just buying a single company, you are buying tiny pieces of all 500 of these massive companies. This is what we call instant diversification. Instead of putting all your eggs in one basket, you are spreading your investment across a huge chunk of the American economy. So if one or two companies have a rough year, it doesn't sink your whole portfolio. It is like having a team of 500 players instead of just betting on one star player. Another really sweet thing about VU is its incredibly low expense ratio. It is only 0.03%. That is practically nothing. We're talking pennies for every $1,000 you invest. This is a huge deal because those fees, even small ones, can really eat into your returns over time. It's not like you are paying a financial advisor 1% or 0.5% every year just for them to try and beat the market. With VU, you are essentially owning the market, and you are doing it for an incredibly low cost. And the reality is, most financial advisors and even actively managed mutual funds struggle to beat the SP 500 over the long term. It is incredibly difficult to consistently outperform the market, so why not just join it? Even Warren Buffett, who many consider the greatest investor of all time, has repeatedly advised most people to simply buy the SP 500. He built his wealth on picking individual stocks, huge winners, but he is telling everyone else to keep it simple. If he, the legendary investor, is saying this, I think it is pretty good advice for us. Regular folks taking his advice, in my experience, is definitely not a dumb idea. Now, let us talk about returns. The average return of the SP 500 can swing year to year, but historically, it averages about 10% annually. That is a really nice number. Some years, it might be even better, like over 20%. For example, if you look at 2023 and 2024, the market saw a strong rebound from 2022 with gains of over 20% in back years. But it is not always sunshine and rainbows. There will be years when it goes down. I've seen some big ones, like the dot-com bubble crash from 2000 to 2002, or the 2008 housing crisis. And more recently, the COVID crash in 2020 and the market drop in 2022 due to inflation and rising interest rates. The key thing to remember about the SP 500 is its resilience. It has always eventually recovered and gone on to reach new highs. This brings me to the power of consistent investing and compound interest, especially for us in our 20s. Let's say you are 20 years old, starting with nothing, and you decide to invest $500 every month until you are 60 for 40 years. We conservatively assume an 8% average annual return, factoring out inflation from the historical 10%. After 40 years, you could have a staggering $1.5 million. The truly mind-blowing part is you would have only invested $240,000 of your own money. The rest, over $1 million, comes from the magic of compound interest. Time truly is your greatest asset here. Let's push that a bit further. What if you invest for 45 years until you are 65? That number jumps to $2.3 million. Those extra 5 years added $800,000 to your investment account. That is a huge difference for just 5 more years of consistent effort. And what if you could increase your monthly investment over time, maybe to $1,000 a month? In that same 40-year scenario, your total would be $3.1 million, even though you only contributed $480,000. If we stretch that to 45 years, that number skyrockets to $4.6 million. That is the incredible power of even 8% a year, consistently invested over decades. $500 or $1,000 a month over 30 or 40 plus years can make you very, very rich. I think one of the biggest struggles for people in their 20s is this desire to get rich quickly. There is so much pressure, to own a house by 25, have a certain amount invested, or be making a specific salary. But with the SP 500, you are going to get rich slowly. It is not an overnight thing. But the more consistent you are, the more money you invest, the larger your portfolio will grow. It won't go up 100 times overnight. It won't have some crazy flashy return. But it will go up a very substantial amount, especially if you stick with it consistently for decades. Think about it this way. Let's say you reach a point where you have $100,000 invested. If the market has a really good year, let's say a 20% return, which I know is higher than the average 10%, but it happens you just made $20,000 without lifting a finger, without adding any more money. If you started January 1st with $100,000, by December you have $120,000. And to make it even more exciting, imagine you eventually reach $1 million invested. A 20% return in 1 year means $200,000 added to your account. That is life-changing money. Now, reaching $1 million or even $100,000 might seem incredibly far away right now, but the more you invest earlier on, the easier it gets. Going from $0 to $10,000 might take you 6 months, but then going from $10,000 to $20,000 will probably take less time, assuming the market is growing at its normal rate. Then 20 to 30 is quicker. 30 to 40 is quicker, and it just keeps accelerating. It is a snowball effect. You might only have to invest $50, $60, or $70,000 of your own money, and then your portfolio will do the rest of the work to get you to $100,000. And with the SP 500 returning 10% a year, it definitely beats inflation over the long run. Inflation is usually around 2% a year, so this is far better than just holding on to cash. If your money is just sitting in a checking or savings account not earning interest, its value is actually decreasing every year. The dollar you spend today will be worth less next year because prices generally go up. So why do I believe the SP 500 is perfect for you in your 20s? The main reason, and I touched on this, is time. You have so much of it. Compound interest does all the heavy lifting for you, whether you start at 20, 25, 29, or 30. If you start in your 20s, you have an incredible advantage. Time is your absolute best friend. When it comes to compounding, of course, the interest rate matters too, but ultimately, the longer your time horizon, the better. We just saw that. With the difference between a 40-year and a 45-year investment, it made a massive difference. The next reason it is perfect for people in their 20s is how incredibly low effort it is. You don't need to check it every day. It is not complicated at all. If the market has a good year, great. Just keep buying consistently. If it has a bad year, that is okay too. My mindset is this: if I put money in and it goes up, awesome. My $1,000 is now worth more. But if I invest $1,000 and the SP 500 drops, that gives me an opportunity. I get to buy a historically appreciating asset at a discount. It is like seeing a pair of shoes you really want go on sale for 20 or 30% off. You are much more likely to buy them, right? So you should view market dips that way. It is a win-win scenario. Either your investment goes up and you make money, which is fantastic, or your investment goes down temporarily, which is totally fine, and you get to buy the dip, accumulating more high-quality assets at a lower price. This logic will serve you well long term, especially during crashes when the market might drop for 6 months, 8 months, or even over a year straight. Those are usually the best buying opportunities. I also love that it is low cost. As I mentioned with VU, the expense ratio is incredibly low. You are not paying a manager 1% a year to manage your money just for them to underperform the market. I honestly believe most people don't need a financial advisor, and I'll probably make a whole video about that. Those fees can really eat away at your returns over decades. The difference between getting 8% a year and 7% a year over a 30 or 40-year period can amount to hundreds of thousands of dollars. So the low cost is a huge benefit. Another massive advantage is how much less stressful it is. When you invest in individual stocks, if you put all your money into 5 companies, you are essentially betting everything on those 5 companies doing exceptionally well. They need to consistently report strong earnings. Their business operations can decline. You need to constantly monitor their revenue profit and free cash flow growth. You'll be poring over earnings calls, analyzing their business models, and you are basically relying on all your individual stock investments to keep performing well over a very long period. It is a lot of work and a lot of worry. Think about it. Many companies that were titans in the 90s completely vanished or struggled in the 2000s. Lots of companies went bankrupt. A company can perform brilliantly for 10, 15, even 20 plus years and then hit a horrible 5 or 10-year slump. Companies like 3M or Walgreens are good examples. I remember growing up, Walgreens was everywhere, and it still is. But as a stock, it has been a terrible performer over the past decade. If you told someone that in 2004, 2005, they would have probably laughed at you. AT&T is another perfect example. It was a fantastic company, even doing great in the late 90s. But since then, it has been a poor investment. It's not a good company to hold for long-term growth. When you own the SP 500, you don't have to stress about individual stocks. Remember, it is the 500 largest companies. If a company like Apple, currently one of the world's largest, were to drop out of the top 500, say it falls to rank 510 or 515, it simply gets removed from the SP 500. The SP 500 has a built-in mechanism for filtering companies in and out based on whether they meet the criteria. And as companies grow or shrink, their allocation within the SP 500 changes. For instance, Nvidia has performed exceptionally well over the past 5 years, becoming a larger percentage of the SP 500. This is great because as companies do well and get bigger, they represent a larger portion of your total investment. It's always nice to see your winners pulling more weight. Ultimately, when it comes to investing in your 20s, it is about consistency. You don't have to be the smartest person in the world. You just have to be the most consistent and put in the effort. If you do that, you see a lot of really good results. So how do you actually invest in the SP 500? It is straightforward. You can open a brokerage account, which is just a general investing account where you can deposit money, buy stocks or ETFs, and sell them when you want to take out cash. You can move the money around as you please. Just be aware that if you sell for a profit in a taxable brokerage account, you owe taxes on those gains. So open a brokerage account. I personally use M1 Finance, but Vanguard or Fidelity are great options too. Then you just search for the ticker symbol VO and start buying shares. Many of these platforms also offer automated investing features. You can set it up to automatically buy a certain amount every week or month. So you could set it to buy $500 worth of VU every month, and you won't even have to think about it. The money gets pulled from your bank account, put into your investing account, and VU is automatically purchased for you. From then on, all you have to do is hold long-term, just keep buying and keep holding. Whether the market is doing well or having a tough time, it's truly that simple. People often overcomplicate it, thinking there is some secret strategy, but it really doesn't have to be complex at all. Another option is to invest in tax. Advantaged accounts like a Roth IRA or a 401k, these offer some extra benefits like tax-free growth in a Roth IRA. At the end of the day, what makes an investor truly successful is time in the market, not timing the market. Many people forget this crucial point. The SP 500 has never had a negative 20-year period. That is a pretty reassuring fact to keep in mind. Now, some common questions or pushbacks I hear about the SP 500. People might say, well, that sounds kind of boring. I don't want to invest like that. I genuinely believe that investing in a boring and consistent way is how you build serious wealth long term. Those flashy plays, day trading a stock in the morning and selling it in the afternoon, or buying options hoping for a huge percentage gain, that is all emotion. And honestly, a lot of it is just gambling. When you invest consistently in something that has a proven track record, you see very consistent results over the long term. It is like working out. Someone who exercises 3 or 4 times a week and eats healthily will see much better results than the person who goes to the gym once every 2 weeks and tries to lift as much as they possibly can for one day. Consistency always wins. Investing is very similar. Another question is, what if the SP 500 crashes? What do you do then? You just keep buying more. Seriously, the SP 500 has always crashed and it has always recovered. Whether it was the Vietnam War, the oil crisis in the 70s, high inflation, the tech bubble, the 2008 housing crisis, or the COVID pandemic. There have been so many historical events where people panicked saying, oh no, the SP 500 is going to tank. Everything's going to hell. We all going to lose our money. And every single time it has bounced back. So if it does crash, stay calm. Keep investing if you can. Avoid checking your account entirely. That is honestly a great way to handle it. I try to remove emotion from my investing decisions because long term, the more you buy and the longer you hold, the better you will do. What about dividend income? VU actually pays a dividend a little over 1%. I know it is not a massive amount, but over a long period, that can add up to some pretty decent cash flow. Plus, you can reinvest those dividends to accelerate your compounding. So, while the dividends might not be huge upfront, they have grown over time, and the yield can sometimes get higher, even over 2% when the market is down. That is another nice little bonus. Someone might also ask, shouldn't TI buy international stocks too? Personally, I don't feel the need to. I believe
Yo,
the U.S. economy
I
will
gotta chill
continue
right
to be
now.
one of the
Oh
strongest,
my-
if
I
not the
can't believe I just
strongest
hit all those
economies
shots
for
and
the
didn't
next
miss.
10, 15,
I'm not even gonna
20
reload
plus
either,
years.
just
I
so
do
you guys
also
know
argue
I'm
that many
actually
large
hitting all my
U.S. companies
shots.
are
I may
already
just back
global
up for a
players.
second.
Think of Visa or Microsoft. They
Nice.
operate
Alright,
all
come on,
over
come on,
the
come on.
world, not
Right
just
there.
in the
Oh,
U.S.
shoot,
The
they're
SP
pushing this
500
side.
includes many companies that are truly global.
They don't
in their
take out my
reach.
Harrier.
So
My Harrier
you are
might be
getting
able to get
plenty of
some
international
kills, which I'm
exposure
hoping.
already. Those are some common
my.
questions and points of contention people
Help
have.
me out,
But now I want to
Harrier.
talk about why
Chopper
most people
standing by.
actually fail at
Oh boy.
investing.
No
And these
stinger
are all
comes out,
mistakes
I
I
might be
made
good.
myself. One of the first things is chasing way too much hype. Whether it is putting all their money into a single stock like Tesla or Palantir, or buying into meme stocks like GameStop and AMC, or trying to
Nice,
trade
good
crypto,
spawn.
hoping some tiny coin will go up 100 times. If enough people invest
Come on, where
chasing
they at?
hype,
Where they
in
at?
my
Oh, spawning
opinion,
back
is a
over there.
complete waste of time. I know so many guys, even in their mid to late 20s,
kills,
and I am
come
about
on.
to turn 27 myself, who are still chasing hype. They've been doing it for years.
Yes,
Meanwhile,
let's
I've
go.
just been
I
investing
know realistically I'm gonna
consistently,
get
and
some
I've seen
comments
far better
saying,
results
yo,
than
you
them
got
because they
like
haven't
nine-
seen any results at all. They
9
LL put
kills where you didn't
25,
miss a
50,
bullet,
or a
but
couple of $100.
I'm gonna
into some
continue
meme
after
stock
this
or
chopper gunner's
cryptocurrency.
over.
They LL tell me, oh look, I turned my $100
Sheesh.
into $500, and then that $500 goes right back to zero because the meme stock or crypto tanks. It is just a really
of course I had to
counterproductive
choke the first shot
mindset, and it
after.
won't get you anywhere long term. Another reason people fail at investing is trying to time the market. You LL hear a lot of people say, hey, I am going to wait until the
Anyways,
market dips,
GG.
and then I
Hopefully you
LL
guys did
buy.
enjoy the
I don't
video.
think you should do that.
This
I
kinda
think you
did
should
take
just
me some
start
time to
investing
do,
as soon
but
as
if you
possible,
have more
because
challenges,
trying
leave
to
them down
time
in
the
the
market
comments
is a
below.
losing game.
Let's try
For
and smash
example, if you were
500 likes
sitting
in
there
the
in
video.
2024
Thank you.
waiting